Well, the recession may have ended 7 years ago, but persistent underemployment, low home ownership rates, and stagnant wages remain. According to a new Wall Street Journal report this morning, the economic trauma of the financial crisis still weighs on millions of Americans. Those people who lost their jobs during the recession, earning much less money when they re-entered the workplace. They're also much less likely to own a home, and many are still struggling with the psychological problems around that. I want to bring in R.J. O'Brien, managing partner at John Brady. Good to see you, John. Thank you so much for joining us. Also with us, the Wall Street Journal's chief economics correspondent, John Hilsenrath. John, good to see you. Thanks so much for joining us.
Good to be here.
Yeah, and you know, we wanted to really cover this because this is a big week for retail, big week for the consumer. We've got all these retail earnings coming out, and then at the end of the week, we've got retail sales. This story in the Journal this morning, bottom line is that most people are not feeling the recovery.
They're certainly not. And, you know, one of the things that I think was most important about this story is it went beyond looking at what we call wage scarring, the fact that when you lose a job during a recession, your chances of making up those lost wages are really low. We looked at the psychological scars, you know, the incidence of suicide, substance abuse, depression. All of these are higher for people who are laid off during a downturn. And it even affects the children of people who are laid off during a downturn. For instance, they're more likely to be held back a grade or to get lower grades on their exams. You know, these are really long-term effects.
Long-term effects because it is a psychological thing, you know, because they begin the story, John begins this story and his colleagues here at the Journal by looking at one person who says it's not just that I'm making a fraction of what I made when I had this technology job in the year 2000, but everywhere I go, the first question is, what do you do? And it's grating. It's grating.
This guy was making $120,000 a year back in 2007, and now he had to leave his family to go finish his bachelor's degree. You know, it's deep.
Well, people are mentally, it's just like corporates. You're mentally scarred by what happened in 2008. It takes a long time to get back to where you were pre-2008.
I would argue, I would go a little bit deeper. The social contract has been broken. Low interest rate policy has unintended consequences. And what we no longer have in this country is the power of compound interest. So these people don't have savings, and they don't have savings that compound at a meaningful rate.
Yeah.
And thus,
that's a great point.
They're forced to do other things that they might not otherwise do. Yeah. And that's a challenge as well.
What about that, John? I mean, we're talking about negative interest rates. You can't even get a return on your money in a savings account.
I think this raises a really important and interesting question, which is that, you know, one of the reasons interest rates are lower is because the Fed is trying to spur the economy to create more growth. And this raises the question of what is the government's role in a downturn? You know, some people would argue that the government needs to let the excesses just kind of wash through the economy. But if we know that millions of people are hurt so deeply and for such long periods of time when we have a downturn, is it the case that the government should be doing more? Should the Fed be doing more to try to get the economy going right now? It's a hard question, and I don't think we resolved it.
It comes back to planning and fiscal stimulation rather than monetary policy.
You know, John, the 14 million people referenced in the Journal story, to me, are like the forgotten man from the Depression. These are the people who paid the price for the administration's policies over the past 8 years.
Not just that, but they're the people in the streets. They're the ones who are the most angry and most vocal going into an election cycle, which has the establishment very, very nervous.
Yeah.
And
they're also the people who paid a price not just for the government's mistakes before and during the crisis, but also for Wall Street's mistakes. Let's not forget the role that all this subprime lending and bond bundling had in creating this thing in the first place.
It's the unwillingness of corporates to focus on the long term, and the fact that basically, you look at the S&P 500, it's shrinking. Buybacks and dividends exceed retained earnings, which means that corporates are returning more money to shareholders than they're investing.
Well, they're sitting on cash. They need incentives to go out and hire people and invest in R&D.
Well, then you come back to fiscal policy.
Exactly.
But this is exactly why Bernie Sanders and Trump have the popularity that they do right now, because all I know for sure is that people want their anger validated. There's a lot of politicians that aren't doing that. There's a lot of pundits that are still poo-pooing it away, and people are so angry. That's why Bernie Sanders has this revolution right now, whether or not it's logical and lives in the realm of of reality and possibility, people are still responding to his message.
By the way, any thoughts, you guys, on the top story in the Journal, and we reported it yesterday, and that is Lending Club. Obviously, this is tarnishing other smaller mortgage companies, but the CEO was ousted. The board said it found problems with loan practices, disclosure about a personal interest, investment in the firm. Stock was down 35%. John?
I think it's a factor, once again, of low interest rates. Companies such as this are going to have to do funnier and more creative finance in order to generate profits or increase revenues to return to shareholders. And it's just this low rate environment that's pushing corporations and corporates to do things they wouldn't otherwise do.
Yep. John Hilsenrath.
Well, I would just argue that the low rate environment is a function of the very weak economy, so these things play on each other.
Oh, that's true. Any catalysts from your standpoint that we should be looking for in terms of when we could see a change in this growth story or lack of?
No, I mean, I think this is what we've got. We've had it for the last 7 years, and I don't see any reason to think that it's going to change.
No change.
You know, especially over the next 6 months when there's so much uncertainty about how this election is going to play out. Who's going to go take a risk now?
Yeah, that's true. And you're not expecting a rate hike this year,
No,
John Brady.
the Fed's on the sidelines for the rest of the year.
Wow.
They've got their reasons for it, Brexit and the political cycle here. And likewise, there's just very little inflation.
Yeah, we'll talk about Brexit, by the way. I want to get your take, Martin Sorrell, on Britain potentially leaving the EU in the program.
We'll stay in.
You're staying, okay. John Brady, John Hilsenrath, good to see you both, gentlemen.